passionate about planning for their future rise above investment myths to build real wealth. Isn't that really just common sense financial advice?
It's both.
Oh, okay. It's Only Money with Scott Brown from Edgewater Family Wealth.
Good and loud for Scott Brown, guys. There he is. What's up, big man? How you doing?
Doing fantastic. I was just telling Jack that I'm in Greenville, South Carolina, which is, I think, maybe the coolest city in the United States right now.
One of the fastest growing spots in the nation, my man.
Yeah. It's the vibe here is unbelievably cool. Everybody's nice. There's like this progressive, and I don't mean in a political kind of way. I mean like in culture and art and in food and just the vibe. Everybody's nice. Everybody gets along. Southern hospitality with really good eats.
City is supposed to be absolutely gorgeous, and had a friend that moved there a few years ago, and to kind of get away is like the final thing, kind of place he was going to retire, and absolutely loves it. It's
yeah. I think everybody followed him, by the way.
Yeah. So Scott, the funny thing is a few years back after the pandemic, we started doing we did a story about a thing called Zoom towns, and the whole phenomenon was this. When people started working from home and employers started kind of okaying that, and saying it was fine,
yep.
People started saying to themselves, well, if I can work from home, why the hell am I living 10 minutes from an office I don't have to go into? I'm going to go live where I want. And they started kind of searching the nation for these little wonderful towns to go and live in. And all they really needed was really high quality internet. And they could live and do and where they wanted. In Greenville, South Carolina was one of those places.
Yeah, I think Bozeman, Montana was one,
yep.
and outside the U.S., I think Portugal was like the number one destination for that kind of activity.
Absolutely, for sure. Well, when I got your text this morning, of course, Scott owns Edgewater Family Wealth, has been doing it here in town for 37 plus years. And by that, I mean giving sound quality financial advice to people who want to better their lives as they near retirement, get themselves tuned in. And Scott, before we get started with what you want to talk about today, you did put a really interesting little paragraph at the top of your text today, and I was really I was interested to see how this would go. I was really excited to talk to you today to find out how the Saturday seminar went. And the reason why is this. Most of your seminars are during the week, 11 o'clock in the morning or so, 11:30. It's a lunch thing where you stop in, you grab lunch, you learn some things, and then maybe make some decisions about your life after the fact. I told you that one of the complaints we got was that we needed one of those seminars on the weekend because the people who are out there, grinding out every day, your blue collar guys out there grinding out, would love an opportunity to learn some things to make their financial life a little better. And I was wondering how that went because if I remember right, it sold out pretty quick.
2 days, yeah, Jim. If nothing else, I'm a man of the people, right? They ask for it, we bring it to them. That's what we're doing here. It was incredible. And to be honest with you, after all these years, you'd have thought I'd have figured this thing out that working people can't come to or at least sometimes can't come to a weekday event. But no, it took you guys to kind of point that out to me. And I thought, well, let's fix that problem. So we did an event. It was out in Lake Mary. We're kind of trying to make sure people from, D-Land or Deltona or Mount Dora or Lake Mary or Daytona. And we had folks from all the places I just mentioned come out. And it was a really engaged group. They seemed to, and it was a mix, it was what we call a mixture of acquirers and refiners, acquirers being people trying to learn the beginnings of the wealth accumulation and how to do that. And then the refiners are folks that, they're kind of in that red zone. They see the finish line not too far off and they'd like to start making changes to prepare themselves for that phase of life. And it was a great event, great questions. We had Todd out, who's our estate planning attorney. He got a ton of questions. Of course, Greg Rossler was there. He always blows people's minds with his knowledge on Medicare and Social Security. So it was like a 2-hour ordeal because people had so many questions. So the short answer is it was fantastic and the people were great. And I think a lot of people got a lot out of it. I certainly did. I certainly learned a lot about what we need to be talking about. Yeah,
that's really good. And what was the makeup of the crowd, Scott? What kind of employment were we talking about when people came in? Were they all blue collar guys? Were they just people who that was their only opportunity to come out? Was it mostly men, mostly women, or?
There was a lot of couples, and it was diverse. I think we had three or four couples who I would say probably in their late 30s to early 40s, really trying to get a handle on this thing. And yes, there was most definitely some blue collar folks, the people that do the hard work in this country. There's a bunch of those folks, but there was also a couple of entrepreneurs I came to find out later, and they approached me later at the event. And I realized these were folks that had started their own businesses. And, if you're an entrepreneur, which you once were, Jim, and still to some degree are, you don't get a day off. So, if you're an entrepreneur running your own business, you're lucky if you can get out even on a Sunday.
Right.
So we obviously brought some of those people out as well.
Love to hear that, buddy. I love to hear that. Well, we'll look forward to, as the summer comes to a close and we fire these things back up in September, we look forward to doing more of those weekend events so that we can get some more people in there and learn the things that you've accumulated almost 40 years now in this business. But let's move on to what you want to talk about today, Big Dog. You always bring some very interesting stuff, and this one today is no exception. It says why your balance sheet matters more than your return number. So is that the overall as opposed to the short term?
I think people get I think what happens is people don't consider all aspects of their life important. They open a stock account or a brokerage account, and then that's where 90% of their focus goes. So if you get to the end of a year like 2008 or 2000 and 2022 more recently, if you get to the end of a negative year with your brokerage statement, you think the world's about to end. But the reality is you have to look at the bigger picture. We're going to have bad market years. We know statistically 1 out of every 3 or 4 years is going to be a real punch in the face. You have to accept that that's reality. And if your whole life is dependent on the return that shows up on your statement at the end of every given year, you're going to get yourself in trouble. You're going to make stressful, bad decisions. And a way to avoid that is to say, all right, well, let's look at 22. Let's say, in 22, you had a crummy year, you were down 10, 12%, which the market was down 18. So if you were down 10 or 12, you should have felt good about yourself, but you don't, because your only source of focus is your brokerage statement. But what if you looked at your mortgage account? What if you got to the end of the year and you looked at your mortgage and realized, well, wait a minute, my account's down, let's call it 10 grand or 12 grand. But you know what? I managed to whittle down my mortgage by 10 or 12 grand, and my house appreciated by 5 or 6%. So if you look at those two things together on my balance sheet, I'm net ahead for the year. And the other part of that is looking at your debt. Maybe you paid off a credit card. Maybe you bought a rental property. Maybe your stock options at work appreciated. Maybe your 401k appreciated. All of these things are part of your balance sheet. So if you're just focused on one part, and I get this a lot in the office, is somebody will come in and say, oh, that was a tough year, I'm really miserable about it, or whatever. And I say, yes, but Mr. and Mrs. Smith, if we look at your balance sheet, which P.S. I make all of my clients build a balance sheet so we don't have these kinds of conversations. When you look at your balance sheet, you're actually 20 grand ahead, not the 5 grand you think you're down just because your brokerage statement's down. So I think it's more of a big picture concept. But most people, Jim, to be honest with you, when they come in and they meet with us for the first time, they want to show us their brokerage statement. They want to talk about their returns, and that's fine. That is a big part of what we do. But the reality is it's a small or medium-sized part of what you should be worried about.
Right. All right, 407-916-1041. Talking to Scott Brown here from Edgewater Family Wealth, edgewaterfamilywealth.com, if you want to check out some of the information they have online. And there's tons of it, by the way, plus the 2 books that he wrote. Let's move on to number 2 here. The 6 biases that are hard for investors to overcome. So these are 6 biases. I don't really understand what you mean by that as a bias that's hard to overcome for an investor.
Oh, there's so many. So I'll start with the first one, which is recency bias. Recency bias is whatever happened yesterday is going to happen tomorrow. So a lot of investors get themselves in trouble because they think, oh, the market was down yesterday or last week or last month or last year. Clearly, that's a trend that I've identified, right? We've talked many times about people pattern seeking. Human beings are pattern seekers. And they believe that if NVIDIA was up 5 days in a row, that NVIDIA is a can't miss stock. I see Jack smiling right now. So, people want to talk about. Okay. So NVIDIA is the popular stock right now. NVIDIA is what anybody you talk to, any investor you talk to, CNBC comes on, they're going to talk about NVIDIA because it's the hot stock. And what people believe is what it has done is what it will do. And I'm not judging one way or the other. on NVIDIA itself, but we could have had this same type of conversation. This same fervor occurred over Enron, MCI.
Right.
I mean, the list goes on and on of stocks that we felt this way about that turned out just to be stocks. They turned out to be companies, not things that just because they did well yesterday, they were going to do well forever. It also, recency bias causes people to sell when they shouldn't sell. Well, look, I got my statement last month on my 401k and it was down 7%. Clearly, it's going to be down 7% next month. Example of that would be December of 18. We saw the market drop 15, 16%. Your 401k statement looked like Swiss cheese. Many of you lacked discipline and you got out. You wouldn't be up the 35 or 40% we're up since that time had you had recency bias for that 1 month. So recency bias is a big one.
And let me tell you, man, that you are 1,000% right, because I mean, it was hard to sit through watching my life savings get completely decimated by the market twice in the last 15, 18 years, and just kind of know and trust the system. That was very difficult to do. Very difficult to do.
You got to trust the system.
But you
got no choice.
You have to trust that it's going to self-correct. You have to. It is really hard as you sit there and every day. Matter of fact, Jim Phillips, who used to work here, came on the air during 2008 when that downturn hit, and he goes, do not check your 401k. He's like, do not look behind that door where you hear all those crazy sounds coming out of. You don't want to know what's behind there. And I did check mine, and I gasped greatly. But you're right. It has come back twofold for sure. It's done quite well, but it's kind of weird how that works. Let's move on to the next bias.
Yeah. So endowment bias. Endowment bias, you believe that because you're in proximity to something, it must be good. And I'll give you an example. Or let me ask you this question. What do you think the number 1 and 2 stocks owned by the residents of Seattle are?
I would say, is Starbucks publicly traded?
Yep.
I'd say Starbucks and
Boeing.
Boeing. Yeah, there you go. I would say Starbucks and Boeing.
Yeah, and you'd be correct. What about Atlanta?
FedEx and Coca-Cola.
And what about Orlando?
Disney and hold on. I would say Disney and maybe
Big military.
One of the I was going to say
military.
one of the contractors here. I can't.
Harris.
Harris.
Lockheed.
There you go.
Lockheed. Yeah. So the question that begs asking is, why is that? Why is it that we own in Orlando Lockheed and Disney more than any other stock? It's because we hear about them all the time. We know people who work there. And because we know people who work there, we believe that we have some insider information as to how well Disney or Lockheed's going to do. And again, this is not a judgment on whether Atlanta people are making a bad decision by owning Coke. It just shows you how nonsensical some of our biases are.
Right.
I live in Atlanta. I drive past the Coke. I literally drove by the Coke place on my way to Greenville. And it makes sense. It's just permeating your brain. So that is endowment bias. We believe, and it happens to people who work places. So all the people at Enron who worked there owned mostly Enron in their 401k. Thus, when Enron finally was revealed to have been mostly a fraud, they all went down with the ship. Had they diversified a little bit and not had endowment bias, and we see that here, we see that when we meet with employees from the major corporations in Central Florida, because they work there, therefore this must be a good stock, right? So this is just something you want to be aware of. The third bias is sunken cost. And sunken cost basically means that you're throwing good money after bad. You bought an investment in real estate and you thought it was worth $500,000. You paid $3 for it. You put $2 into it, and lo and behold, a few years later, it's worth $300,000. So you're down $200,000. You've sunk all your money into this thing, and you're just going to keep putting money into it till it gets better.
Don't you say that? I just bought one. Damn it! Don't you dare do that.
Yeah, but you're living in that one. Yeah, you're living in that one now.
Don't you dare say it.
So you're okay. You're okay.
Good. All right.
Number 4 is anchoring. We anchor to things. And the biggest example of that is something I call the high water mark. Client comes in, give you $100,000. 10 years later, they got $250,000. By the end of the year, they're at $230,000. What do you think they're thinking? Are they thinking they went from $100,000 to $230,000? Or are they thinking they went from $250,000 to $230,000? What's their big concern?
I guess the first one there.
No, the 20 that they lost.
Oh, yeah.
That they lost. Yeah. They're so upset that they went from because to them, they've anchored on the $250,000. They don't recognize that they've more than doubled their money. All they know is they had $250,000 yesterday and they got $230,000 a month later, right? That is anchoring, and it's unhealthy because when you anchor like that, you make bad decisions. Well, obviously, and again, that creates recency bias, which says I went from 250 to 230 recently, therefore this is a bad investment, not I went from 100 to 230 and therefore it's a good investment. The fifth one is loss aversion. That's a simple one. So if you look at Berkshire Hathaway run by the infamous Warren Buffett, in 2015, he was down 12%. In 2008, he was down 32%. Do you think Warren Buffett has loss aversion? In fact, I would argue that he enjoys losses.
Yeah.
And the reason for that is he can buy stuff cheap. Yep. Warren Buffett sits on cash and waits for the market to fall apart and for you to sell your stuff so he can buy it from.
Yep.
And the last one is confirmation bias. Confirmation bias is you trying to convince yourself that a decision you've made or continue to make, no matter how bad that decision seems to keep turning out, is the correct one. So you go to your buddy at the bar to seek confirmation. You know, my wife doesn't understand me. You know, she just doesn't get me. But you get me, Jim, because you and I are getting drunk every night at the bar. My wife does not. Let's confirm together that coming to the bar every night makes a lot of sense. Do you agree, Jim?
No, I do not. I kind of agree. Yeah.
Yeah.
A little bit. There's a little agreement there, Scott.
Yeah. My wife listens. I have to say stuff like that sometimes.
You do. But that's confirmation bias. Is you bought something and now you're seeking somebody, despite all the evidence against the decision having been a good one and you should maybe make a change, you're not saving or whatever. You go to your buddy who also agrees that 401ks are a ripoff. Don't you agree that 401ks are a ripoff? Yes, I agree. And that's because neither one of you are putting any money.
Right. Well, you get that a lot in crypto. I know that when that first came around, you're getting a lot of that in crypto. People just believed in it so much, they just kept pouring money into it because they'd convinced themselves that it was coming around. Yeah.
I mean, crypto's a great one. I mean, the crypto bros are not playing. You know, you try to disagree with a couple of crypto people, you might get beat up.
Yeah.
Right? Because they don't want to hear it. And again, I'm not picking on crypto. Crypto may turn out to be something I don't understand, but at this point, I think it's just silliness. And people, if you say that to them, if do this to a crypto person, explain to me what it is, right? And then they'll look at you like you're the idiot because they can't explain it, right? So the reality is confirmation is a problem for a lot of investors because they'll do the Google search that confirms whatever silly thing they've already done, rather than what they should do is find somebody with a dissenting opinion to lend some credibility. And you know what? If you listen to the dissenting opinion and you still think you're right, well, then maybe you are. But most people will not do that. They will seek the confirmation.
Right, and at least you gave it a shot. At least you kind of mixed in another possibility. But pretty much you're going to go back to where you started.
Yeah, I mean, I think for most decisions in life, I know myself, I figure my judgment's pretty poor. I always ask my wife before I make major decisions, and she'll usually tell me, here's why that's not a good decision. Now, being the man that I am, I still might make the stupid decision,
sure,
but at least I've sought counsel.
You got to let her know sometimes, buddy. You got to let her know that even if she calls you dumb, sometimes you got to go through with it. It just happens.
We can't help ourselves.
Scott Brown, Edgewater Family Wealth. That's edgewaterfamilywealth.com. Scott, when they visit the website, what would you suggest they go and look at?
Well, I think there's so many resources on there. Not only are all of our podcasts and shows on there, but you can find my book on how to work with a financial advisor. A lot of people are telling me they're really enjoying that book. The I Got a Guy series, which basically tells you what you should ask a financial advisor, what you should look for in a financial advisor. And so I think that's a really good place. Obviously, my book's out there. I Never Made Anybody Rich, which is really a book about my experiences with people and the myths that people believe about financial advisors, that they make people rich. I told the crowd on Saturday, my job's not to make you rich. If you're rich, it's because of something you did. What my job is to help you hang on to or maintain the wealth that you've acquired. So those are two great resources. And then if you want to have a consultation, I urge you, and we get them every week, go onto the website, sign up, somebody will contact you. And as I told the group on Saturday, somebody said, do you have a minimum? And I said, no, the only minimum I require is your interest. If you're interested in growing and learning, and it might be a 5-minute conversation. I have had clients or prospects call in, people who might be prospective clients call in and say, hey, I only have this one question. Is it okay if I ask it? Absolutely. We'll spend 5, 10, 15 minutes on the phone with you if there's one glaring problem you need help with. So we're in the doldrums of seminars right now because it's summertime and people want to have fun,
sure,
myself included.
Yep.
But come September, we'll ramp them back up. In the meantime, go to edgewaterfamilywealth.com. And you can get yourself a consultation.
You guys good and loud for Scott Maxwell, Scott Brown. There.
The other Scott.
I like food too.
EdgewaterFamilyWealth.com. Scott, have a good weekend. We'll see you soon, buddy.